In this session, I'd like to continue our discussion of risk. In the last one, I talked about the risk of investing in a bond. In this one, I want to talk about the risk of investing in stocks. Before I embark on the details of that discussion, let me give you my favorite definition of risk. It's actually the Chinese symbol for crisis or big risk. It's a combination of two symbols, danger and opportunity. Risk is equal to danger plus opportunity. It's a perfect way to think about risk. Risk is neither good nor bad, it's just there. If you want opportunity, you got to live with danger. And by connecting the two, it cautions us. Don't get greedy. Don't go looking for returns without being exposed to risk. You are going to be exposed to risk if you want high returns. So with that in the background, let's think about the risk of investing in stocks. There are lots of different ways of defining risk in equities, but here are three dimensions on which that risk definition can vary. When you invest in stocks, you can think of price risk or cash flow risk. Let me back up. When you buy a stock at a certain price, the price can move from minute to minute, day to day. Why? Who knows? Could be for good reasons or bad reasons. But you as an investor might face that risk either implicitly or feel that risk implicitly, either by looking at what the value we're holding is doing on a minute to minute basis, or explicitly because you have to sell the stock. So that's price risk. The stock price can go up or down. There's another way to think about risk. You buy stocks, and if you're a long-term investor, you might say, look, I don't care what happens to the price. I'm buying the stock for the cash flows or the dividends. To the extent that those cash flows are uncertain, you're exposed to risk. So that's the first way to think about risk in equities. You can think about the risk in the stock price or the risk in the cash flows / dividends / whatever fundamental you bought the stock for. The second way to think about risk is in terms of the total risk. Total risk is any time you get an outcome different from what you expected. That's a risky outcome. However, that outcome might be better than expected, in which case most of us don't think of that as risk, right? So the alternative measure of risk says just focus on the bad outcomes, the outcomes that are less than expected. So risk can be thought of in terms of either total risk or downside risk. And finally, risk can be thought of either on a standalone basis, what's the risk of this stock by itself, or on an add-on basis. If I added the stock to a portfolio, how much risk would it add to the portfolio? Now, I want to also make clear that these risks are not mutually exclusive. Stocks with high cash flow risk might have high price risk. Stocks with a lot of downside risk might have total risk. And stocks with a lot of standalone risk can also add a lot of risk to your portfolios. But there will be cases when the two can give you different answers. So as we go through the risk measures that are available to us, start thinking about which dimensions that particular risk measure uses to measure the risk in stocks. So from the big picture perspective of equity risk, here's what you face. You invest in the equity of a business, whether it's a public business or a private business. You're entitled to the residual earnings, whatever's left over as earnings and cash flows after every other claim has been met. In other words, you're the last guy in line. Now, if it's a publicly traded company, it gets a little worse. Not only the last guy in line, but the managers decide what you get as residual cash flow. The models that try to measure equity risk can very broadly be categorized into two groups. There are models that over the last 60 years of financial theory we've developed. These are theory-based models that define risk in a very specific way. And you might or might not like these models. But that there are alternative models. Some are quantitative, some are qualitative. And I'm going to try to give you as best as I can a full flavor of all of these different choices. Let's start with theory-based models. Most theory-based models define risk in terms of variance of returns. They're price-based measures with the price and dividends included. Variance of actual returns around expected returns. So basically, when I ask you how risky a stock is, here's what you do. You have a measure of expected returns. You look at the actual returns relative to expected returns, and you tell me a stock is risky. Almost by definition, this will require you to look backwards, which creates its own set of problems, but almost all theory-based models define risk as variance of actual returns around an expected return. That's not surprising, and most people intuitively might go along with it. It's the second piece of the theory-based models that makes some people uncomfortable. Most theory-based models of risk and return assume that the investor who's pricing the stock, the marginal investor. So these are big investors who own a lot of stock and trade that stock. Those investors are diversified. You're saying, so what? Well, if you make that assumption, the risk that they see will be the risk that an investment adds to a diversified portfolio. So almost all theory-based models measure risk as risk added to a portfolio. So if you think about the dimensions of risk we talked about before, Theory-based models tend to be more price-focused than cash flow-focused. They tend to measure risk in terms of the risk added to a portfolio rather than risk standing alone. And they tend to look at total risk, with the assumption being risk is symmetric. In other words, if you get a lot of upside risk, there must be a lot of downside risk as well. So let's take the most widely used model in the world still when it comes to theory-based models. Gets beaten up all the time but hangs in there. It's the capital asset pricing model. In the capital asset pricing model, we measure the risk of an investment with one number, the beta. That's a pretty powerful model, right, to capture all risk in one number? To get there, though, here are the assumptions that the model makes, or the steps in the model. First, the model defines variance as its measure of risk, variance of actual returns around an expected return. Again, not surprising. Then it breaks the variance down into variance that's due to the company, firm-specific variance, and variance that's due to macro or market variables. It makes the argument, and this is the biggest part of the model, that since the marginal investor, the investor setting prices, is diversified, the only risk that should be priced into a stock is the risk that you cannot diversify away. So what kinds of risks would these be? They're primarily macroeconomic risks, interest rate risk, inflation risk, etc. The third step in the model, it assumes, because there are no transactions costs and everybody can be diversified, that everybody is supremely diversified. How supremely diversified? We all end up holding a portfolio called the market portfolio, which includes every traded asset in the world. And if you buy into that, then the risk added by an investment becomes the risk added to that market portfolio. That's what beta measures. Beta measures the risk added to a supremely diversified portfolio. The nice thing about betas is they're scaled around 1. The average risk company has a beta of 1. A beta above 1 means you're above average risk. A beta below 1 means you're below average risk. And beta then becomes the measure that we use to get an expected return on a stock. So if I ask you, what would you need to make as a return on this investment? You measure the beta on the investment and you plug it in. You take the risk-free rate plus that beta times the risk premium you demand for investing in the average risk investment to come up with the expected return. Pretty powerful model because it captures all risk in one number. So how do you get the beta? This is how I was taught to estimate betas, and I'm sure if you've taken a finance class, you've been taught as well. I was told to run a regression. What's a regression? Go back to Stat 101. You have a dependent variable and an independent variable. The dependent variable here is returns in the stock you're thinking about. So in this case, for instance, I'm looking at Amgen, big biotechnology/pharmaceutical company, and I've looked at returns over a period, in this case, 2005 to 2007. I take the returns on the stock, and I run a regression against returns on a market index. Which one? In this case, I've chosen the S&P 500. Keyword is, remember, these are chosen. So I could have altered this beta by making different choices. When I run this regression of Amgen against the S&P 500, see that chart to the right? Basically, of all these points, each point, this is called a scatter plot, where each point is a combination. It's from a month of data. The line that's fit through these points is called a best fit line. That's what the regression line is. The slope of that line, which is 0.75, is the beta for the company. You're saying, what's the adjusted beta? It's just the regression beta moved towards 1, but the key number there is that regression beta. So that's how most people get betas. They run a regression of return on a market index against a return on a stock against a market index, and they pull the slope. In fact, most people don't even have to do this. You go to a service like Yahoo Finance or any major finance service. For most companies, you can see a beta for the company. But remember how we read betas. A beta of 1 is an average risk company. In this case, I'm telling you that Amgen is 0.75 times as risky as the average risk stock. I'll also have to tell you that I'm not very comfortable with this way of thinking about betas because it makes beta into a statistical number. It makes beta into a backward-looking number. And what we often forget statistically is even though you get a slope for this line, there's a healthy amount of estimation error, 0.22. So my true beta could be 0.4, it could be 1.15. So let's step back and think about where betas really come from. They don't come from regressions. They don't come from the past. They come from choices companies make. And what are these choices? You tell me what you do as a company, what kind of products and services you produce, and I can pretty much guess what kind of beta you should expect to have. And here's the insight you should have. Betas measure how you move with the market. If you produce discretionary products. Discretionary in the sense your customers can live without your product, they can delay buying it. In good times, you will tend to sell a lot. In bad times, you will tend to sell very little. The more discretionary your product, the higher your beta will be as a company. So if you're a luxury retailer, you should have a higher beta than if you're a department store, and a department store should have a higher beta than a discount retailer. Looking at grocery stores, I would expect Whole Foods to have a much higher beta because it offers expensive discretionary products than a traditional grocery store. So think about the product or service a company offers, and you can start getting insight into what kind of beta you should expect it to have. So you should expect growth companies to have higher betas than mature companies because growth companies often offer niche products. So that's the first stop. What kind of product or service does the company offer? Second stop, what do your fixed costs look like? If you're a company with a lot of fixed costs, in other words, those costs are going to be there no matter what your revenues are, that makes your earnings much more volatile. Companies or businesses with lots of fixed costs will tend to have higher betas than companies or businesses without those fixed costs. Airlines should have much higher fixed costs than personal services. So basically, you tell me what you do as a company, and I can again estimate your beta based on what I know about your business. And the third and the final factor that affects the beta for your stock is how much have you borrowed. Why does that matter? When you borrow money, you create a fixed cost you did not have until you borrowed the money, right? Interest expenses. You got to make those interest expenses in good times, which is okay, but you also have to make them in bad times, which is not. It makes your equity earnings more volatile. So those are the three questions. What do you do? What kind of products or services do you provide? The more discretionary those products or services. In Econ 101 terms, that's elasticity of demand we're talking about. The more discretionary your products or services, the higher your beta. Second, the greater the proportion of your costs that are fixed costs, the higher your beta. Third, the more you borrow, the higher your beta. That's really a much better way to think about betas than to think in terms of a regression slope. Now, there are lots of misconceptions out there about betas that you need to kind of get out of the way because people love to beat up on betas and use that as their reason for not thinking about risk. Here are the misconceptions. So these are not the right ways to think about betas, but are widely held misconceptions about betas. First, you'll see people talking about beta as a measure of risk. Remember, it doesn't measure overall risk. So when I say a stock has a low beta, I'm not saying the company is not risky. You could have a risky company with a low beta. I'm just saying not much of the risk in this company is macroeconomic risk. So what would be a good example of a risky company with a low beta? If you have a young biotechnology company that has a product working its way through the pipeline, very risky company, right? The product might not work it. Remember, that company will not have a high beta because much of the risk in that company has nothing to do with the market or the macroeconomic environment. So the first thing to remember is beta doesn't measure overall risk. Second, there's a misconception that beta is a statistical measure because that's how we get it from a regression. Betas might come from regressions, but as you saw, they come from the decisions you make as a company. That's what drives your betas. Third, you'll see people using betas as if these were facts. In other words, they'll pull a number from Yahoo Finance and say, the beta for this company is 0.85. But as you saw from the Amgen regression page, even when you pull a beta from a regression, it comes with that standard error. So there's a range on the beta. And the fourth, and this is I think the most dangerous misconception, is beta measures investment quality. It doesn't. It measures risk. So I'm not asking you to buy low beta stocks as good stocks and high beta stocks as bad stocks. It doesn't tell me anything about the quality of my investment. That requires an entirely different set of research tools. So if you do use CAPM, use it for the right reasons. If you don't use CAPM, that's okay, because a model does make it has its limitations, and here are three. One is it does make unrealistic assumptions about transactions costs, about information, about trading. Okay? It generally doesn't bother me, but it might bother you. The second is there are people who argue that the model is not that useful because the beta is going to be estimated with error and the equity risk premium is going to be estimated with noise. That's true. But then what model would you use? Every model is going to have that problem. The biggest problem with the CAPM is it doesn't work very well. That's kind of a bad confession to make because I use betas all the time. Betas don't explain much of the differences in returns across stocks. So there are people who look at people using the CAPM and say, if it doesn't work that well, how come you still use it? And I respond with what Milton Friedman once said. It takes a model to beat a model. It's true the CAPM is not a very good model, but you have to give me an alternative, something that works better. And that's what we're going to embark on next is there something else out there that works better than the CAPM? Within the constraints of theory-based models, over the last 40 or 50 years, people have tried. God, have they tried? Many of these models have come out with a great deal of fanfare, but they've never got the foundations that the CAPM has had in terms of getting used all the time. Here are the alternatives to the CAPM. Remember, in the CAPM, I took all of the risk that a company was exposed to, that was market risk, that was macroeconomic risk, and compressed it into one beta. That's a pretty tough task to do, right? The arbitrage pricing model and multi-factor models are expanded versions of the CAPM, where you allow for multiple sources of market risk and a beta against each one. In the arbitrage pricing model, those betas will be against unnamed factors. Basically, you're saying there's macroeconomic factor 1, macroeconomic factor 2. It's a statistical way of thinking about risk. In multi-factor models, we put names on the macroeconomic factors: interest rate risk, inflation risk, GDP growth risk, etc. We'll talk a little bit about proxy models, because in the last 20 years, these are the models that people have used either standing alone or in conjunction with the CAPM to try to improve their predictions or assessments of risk and equity. What are proxy models? You might argue that small companies are riskier than large companies. Companies with low price-to-book ratios are riskier than companies with high price-to-book ratios. That's what proxy models do. Is they let something stand in for risk: the size of the company, the price-to-book ratio. And they do improve the performance of these models. How much of the returns get explained goes up substantially when you throw in a proxy. But all of these models stay within the conventional theory framework of let's measure risk as variance and let's break that risk down into risk you cannot diversify away and risk you can. Now, here's why people have trouble with the CAPM, the arbitrage pricing model, multi-factor models, in fact with all of the theory-based models. It goes back to the three dimensions of risk, equity risk we talked about at the start. One critique here is, the CAPM, the arbitrage pricing model, the multi-factor model. We look at all risk, not just the downside risk, and who cares about upside risk? So there are some who argue that your risk measures should focus on just downside risk. These models, for better or worse, get most of their numbers from market prices. For instance, if you go back and look at the beta regression, it's driven by changes in stock prices from period to period. They're price-based models. Even though dividends do affect returns, the bigger effect is prices. And they do make the assumption that the only risk that matters is the risk you cannot diversify away. Now, you might be okay with that assumption, or you might be okay with it for some companies, but for some companies you might say that's not realistic. The investors in this company are not diversified. So I want to talk about 5 alternatives to the traditional theory models that have come into play as ways of measuring risk. The first are accounting-based models. In accounting-based models, in the first set of them, you focus on some measure of accounting, some accounting ratio that you think measures risk as you see it. So, for instance, if you believe that the biggest risk you face when you invest in a stock is that a company might have borrowed too much money, you might take the accounting debt ratio, the debt that they show on the balance sheet divided by equity, either in market value terms or book value terms, and say companies that have high debt ratios are riskier than companies with low debt ratios. You might agree or disagree with it, but if that's your focus on risk, you can find an accounting ratio to go with it. Alternatively, you can say companies that have a lot of earnings are less risky than companies with less earnings, so you could look at some accounting ratio that measures that. You could look at earnings divided by book value of equity or earnings divided by market cap and say if companies have a high earnings to book number or earnings to cap number, they're less risky than companies with lower values for that number. I've just given you a flavor of this, but you can basically find a dozen or so accounting ratios that people claim are good measures of equity risk. The other approach, and this is a little more sophisticated, is to compute what's called an accounting beta. You think, what's an accounting beta? Remember how we computed a market beta? We took the returns on a stock and regressed it against returns in an index, so prices were the big driver there. You could take the changes in accounting earnings for a company and look at how those changes move as a function of changes in earnings for the entire market. In other words, you're doing a regression still, but rather than using stock prices and returns, using changes in earnings. That's called an accounting beta. The only problem is accountants don't measure earnings very often, so your regressions tend to have relatively few observations and much more noise associated with them. But these are both accounting-based risk measures. Earlier I talked about proxy models. These models were made very popular by two very well-known researchers in finance, Gene Fama and Ken French, who about 20 years ago showed that if you looked at returns on stocks over a very long time period, rather than betas, two variables explained differences in returns across long periods. One was what the market cap of the company was. Small market cap companies earned about 3 to 4% more than large market cap companies, and low price to book companies. Companies with the market value of equity was well below book value of equity had much higher returns than high price to book companies. So what they presented was what was called a proxy model, where they said, you give me your price to book ratio and your market cap, and I'll tell you what kind of return you need to make. So if you're a small market cap company with a low price to book, you're a riskier company than if you're a large market cap company with a high price to book. See why I call these proxy models? Market cap and price to book by themselves are not risk measures, but they're standing in for risk. In the 20 years since we have so much more data to work with, people seem to find a new proxy that works every year, which is a scary thought. But broadly speaking, these new proxies that people have found fall into three groups. One are earnings momentum proxies. In other words, companies which have had stronger earnings growth seem to have much higher returns than companies with less than strong earnings growth. So basically, if you read that right, you're saying, well, companies with strong earnings growth are actually riskier. That's why they earn higher returns. It's a little circular, but you got to go along with it. It's also been found that companies that have gone up a lot in the recent past are more likely to continue growing up. So the argument again then is companies that have gone up a lot in the past are actually more risky than companies that have gone down. And finally, liquidity. Because essentially, if you're looking at these proxies, you're basically using how actual returns are played out over time. Less liquid stocks seem to have earned higher returns than more liquid stocks. So what you do essentially is either create a model where you take these proxies and come up with a rate of return you need to make given those proxies, or you incorporate them, you add them on to a traditional capital asset pricing model. And you might have seen some versions of it where the expected return on a stock is written as the risk-free rate plus the beta times the risk premium, the CAPM, plus a small cap premium, or a momentum premium, or a liquidity premium. It is essentially letting something else stand in for risk. There's a third approach which I think is very interesting. If you tell me what you pay for something, I can back out from what you paid what your expected return on that investment is. Put differently, the more you pay up front for an investment, the less your expected return is going to be on that investment. So if I can observe the prices for stocks, I can back out from that what kind of expected return investors are demanding for that stock or stocks collectively. Simple example. Let's say you have a stable dividend-paying stock. It's trading at $20 today. It's expected to pay a dividend of $1 next year and grow, and those dividends are expected to grow 3% a year in perpetuity. You come to me and say, I don't know how risky this stock is. What kind of expected return should I demand on the stock? Here's what I would do. I'd set the price on the left-hand side and back out from the dividend and the growth rate what kind of expected return you're building into the stock price. Expected return would be 8%. In fact, I could do this across sectors and tell you, based upon how people are pricing stocks, which sectors are risky, whether the expected return is high, and which ones are safe. It's actually a process I used after the crisis of 2008 to figure out how much more risky investors found banks after the crisis than before, using this process of backing out the expected return. Obviously, this process gets a lot more complex if instead of dividends you use a measure of cash flows you have to estimate yourself, and also if you have growth in the company. But the structure of the model will stay the same. The process will get more complicated. There's a fourth way to adjust for risk, but rather than try to push up your discount rate or expected return, you try to adjust the cash flows. Okay? This is in a sense what the big value investors claim to do. They say, look, I don't adjust the discount rate. In fact, this is widely passed around suggestion that Warren Buffett doesn't adjust for risk when he invests in companies, because he's told people, I use the risk-free rate, I don't buy into betas. And people then take that literally and say, if Warren Buffett doesn't adjust for risk, I don't have to as well. Well, that's a dangerous thought, because Warren Buffett does adjust for risk, but the way I think he does it, and this is from my reading what he does, he doesn't adjust the discount rate, but he counts only those cash flows that he feels are, if not certain, close to certain. That's called a certain equivalent cash flow. In other words, you're lowering your cash flows for riskier companies, saying, I'll count only those cash flows I can count on. That basically is a risk-adjusted cash flow. And while it's offered as an alternative to the traditional risk and return models, if you want to use this approach, you have to come up with a way of adjusting cash flows that goes beyond just gut feeling. There are ways actually in theory that you can certainty equivalent cash flows, and And if you're interested, you can go in and read up on them. But the basic idea here is you're adjusting the cash flows for the risk by just counting the cash flows you feel the company can deliver. Last approach to measuring risk, which has again a long tradition in value investing, is called the margin of safety. What's a margin of safety? Well, let's assume you have a stock trading at 50. You value the stock and you come in at $55, right? So the value is higher than the price. You're saying, let me get ready to buy the stock. Not so fast. If you have a margin of safety of 20%, here's what you're saying. The stock price has to be at least 20% below the value before I invest in the stock. You see the advantage of this approach? Basically, the more risk averse you are, the larger the margin of safety can be made. It makes you more cautious about buying stocks. You're saying, why not just make it a really high number? Isn't that better than a lower number? There is a cost. The larger your margin of safety becomes, the fewer stocks you're going to be able to buy. And you can be too conservative. You set the margin of safety too high, you might never find a good investment, in which case your money is going to stay in T-bills or cash for the rest of eternity. So I think there's a trade-off. You have to decide how high you can make the margin of safety and still end up with enough stocks to populate your portfolio. But the steps in doing the margin of safety is you first have to value companies. You compare the price to value and use that margin of safety as your mechanism for deciding the trigger point for buying or selling stocks. So here are my final thoughts about equity risk. You can choose to use betas, you can choose not to use betas, especially in investing. I'm not dogmatic about how you measure for risk, but you have to think about risk. I don't even care if you make that risk measure qualitative rather than quantitative. In other words, take companies and divide them into 5 groups based on risk. I'm okay with that, as long as you've thought through risk. I'm not a great fan of creating complicated risk models. So if you want a simple risk model, go for it. Right? Ultimately, though, the one thing I don't want to hear you say is, look, I don't care about risk. Risk doesn't matter. Risk always does matter. The question is how best to bring it into our investments. So summing up again, equity risk can be measured in lots of different ways. It can be measured as price risk or cash flow risk, as total risk or just downside risk, as risk standing alone or risk added to a portfolio. The traditional theory models tend to be focused on price risk, look at total risk, and look at risk through the eyes of somebody who's diversified. So that's how in the CAPM we measure risk with a beta, or in the arbitrage pricing model or multi-factor models, we measure with multiple betas. If you decide you don't like those approaches, there are alternatives. And here are some of the alternatives. You can go with an accounting-based measure of risk, some ratio that you use or an accounting beta. You can go with a margin of safety if you feel that is in fact a more reasonable or a viable measure for you. You can go with proxy models and tell me whether you want let something else stand in for risk. Small companies, technology companies are risky and other companies are not. But whatever you do, please don't abandon your search for a good risk measure. It's difficult enough to invest. It's even more difficult if you don't have a way of thinking through risk and bringing it into your decision making. That's it. Thank you very much for listening.